Good afternoon, everyone. Welcome to this Monday's Wealth Creation Show. And if you caught us at the weekend, you'll know that we are covering comparative analysis today. So this is quite a good one. Quite a lot involved in this. This is right up your street, Jim. And it should really be anybody that's on their wealth creation journey and involved in investments and their financial future. It should be something that you're aware of and something that you practice. And if not, then you're here to learn today, I suppose. So,
Well, we're all students of life, Richard.
yeah.
At the end of the day, you know, I'm still learning as I go. I was talking about, to Ian this morning about I need to learn about passing on generational wealth. I need to learn about trusts. I need to learn about family investment companies, how that works and how you would do this. I also need to learn about things like, how the super ultra wealthy people do this.
Yeah.
For example, I was talking about the Rothschilds, about their fund, and apparently they take out the fund, but eventually when they die, their life insurance policy pays back all the money they took out to the fund. I'm like, whoa, wait a minute, that's something different. How does that work? It's like that's how they keep their generational wealth. It never actually goes down. It just keeps going up and up and up and up, and everybody gets used to it. Now, an easy one for me off the top of my head was, for example, would be actually I need to take out an insurance policy to cover any inheritance tax liability in case that happens. Therefore, the portfolio won't be realized as a result of that. It would be, my insurance would pay off my inheritance tax liability, and the portfolio would just pass to the children, nice and easy, and all the income will be preserved, and all the improvement, all the wealth creation will be preserved as well. So, maybe that's another show we want to talk about later on. But we're on comparative analysis and wealth creation and what that actually means. So let's talk about what it actually means.
Yeah, we'll do a wee bit of info for what it actually is, and comparative analysis, and I mean specifically within context to wealth creation, really focuses on how individuals can assess and compare maybe different financial strategies, investments, and performance metrics and things as well. And in terms of financial planning, it's a really important tool for evaluating the effectiveness of maybe different financial strategies and making really informed decisions about what you're doing from a financial aspect in your wealth creation journey, because they are really important. And we obviously have went through a lot of different strategies through these shows, and I've learned a lot from you, obviously, not just in the show, but out with that. And it's really important to go through, like, obviously mitigate risk and all these things, or you could end up really costing yourself quite a lot of money and time.
It's quite true. It's quite true. My whole life has been a comparative analysis from start to finish, and I'm not finished yet. And every single time I do something, I compare it against something else to think, is that what I should really do with my money? Let me give you a typical example of comparative analysis that I did right now.
Okay.
Do I leave my wealth locked up into my limited company right now and let it grow over a period of time? Or do I realize that wealth and actually borrow it back out? In other words, get somebody else to fund it and borrow against it, and then use that to buy more property to generate more income. Now, let me give you a typical example of what recently happened. Parker Housing Limited, 21% loan to value. So in other words, only 21% is actually the bank borrowing. About 79% is actually my money or my wealth locked up in there. So I decided, let's move that up a bit to 60% loan to value. Let's take out 1.2 million, and then we can take that away and we can use it actually to borrow to another company, which I own, and that will allow me to buy outright these assets. And then what will happen is I bought 9 properties from there outright. So they basically had they didn't have encumbered debt on them. They had unsecured debt, which is through Parker Housing Limited, to buy from there. So then what I did from there is I then used them to then put down as security, because it's unencumbered debt at the end of the day. It's assets as security to buy another 30 properties. So it went up from 9 properties to 39 properties. Now they generate an income every single year in terms of rent of £234,000, and it is an asset of £3 million worth of property. And I used none of my own money to do that. Now, do you think that was a really good way to do that?
That's, to me, sounds like really good financial planning.
Or I could sit on my hands and I couldn't generate the 234,000 a year in extra rent. I wouldn't have the extra, £3 million worth of property. So in 20 years' time, that's going to go up by 3 million. So effectively, if property goes up by 4% every single year, which it does, so no one can tell me any other, because it's always done that. If it does go up, we're talking about every single year times 0.4%, it goes up 120,000. So 234,000 in rents, 120,000 in wealth creation. Job done, eh? Out of nothing.
So, I mean, you've done that, but you think a lot of that and then think, obviously that's quite a big undertaking, and maybe they're not sure about the risk involved, and then they might maybe have the fear and not do the decision that maybe is right.
What's
and
the
would
risk?
earn more money.
What's the risk? There is no risk, Richard. There's no risk. All I'm doing is taking that money and buying more property. If I get to the point where I think to myself, there's a risk, I sell the property and I pay all the money back of the other one anyway. It's all locked into there. It's not as if I'm going out and buying a Ferrari Huracan. That's the thing. There's no risk involved in it. This is the classic example about people saying, do you think I should maybe borrow money against my property? Oh, I might lose it. How are you going to lose it? You're investing in more property. unless the market crashes again, that's the only way you're going to lose it. So my strategy is you can't lose it if you're going to buy more property with it, because it's locked up in more property. But that property you're buying is earning money on it. It's generating income out of it. The property you've got it in right now, which is your home, isn't earning anything at all. It's costing you money.
Yeah, I only raised that question because I know that a lot of people think like that, and that's how a lot of people.
Of course they do. Even Elaine thinks like that. My wife, she doesn't get it. But no, I don't expect everybody to get it. There is only a 5% group in this world for a reason. There's a 5% group, and by your thinking, you will determine whether you're going to be in that 5% group later on, or even now. 5% group is not about money; it's about the way you think. And if you think the way you think, as well as the other people in the 5% group, you're automatically a member of that 5% group, and it's only a matter of time before that money catches up. Now, we talked about this as well, and I talked about Ian. I wonder if I can get to £1 million in rents a year, because I'm sitting about 540 to 600,000. So I wonder if I can get to £1 million a year. Is that possible? Well, I could just wait 20 years and put it up 3% every single year, and I'll go to £1 million anyway.
Yeah.
Is there a risk involved in that? Absolutely not. So I know in 20 years' time, if I sat on my hands and basically put the rent up just 3% every single year, that's no a shocker. Thank you, Patrick Harvey. 3% every single year.
Yeah.
You've taught me to chase the sledge. I just need to put it up by 3% every single year, and over a period of 20 years, it will compound to £1 million in rent every single year. So where's the risk involved in that? There's no risk. And this is what people don't get. I feel banging my own head. What do you not get about this? What do you not understand about property investment and the way this works? What is it nobody's getting? Why do I get it straight away and I understand the whole dynamics of it and I understand properties where it's at? But just no one else gets this, round about me. I don't get it. Why is no one else investing in property like I'm investing in property? Like I started out in property.
Yeah.
I started out with one, about 5 by year 5. And then, year 8, and then I had 36 or 40 or thereabouts, and I was able to retire, from a standing start. But I could have just given up at year 5. But this is why we talk about comparative analysis. Where else are you going to put your money? Where else are you going to use your assets to make more money on? That's what they're there for. Money is there to make money and do good for other people. That's ultimately what it's there for. Yeah. So I'm making money, but I'm buying assets, but putting a roof over somebody's head. So they're benefiting as a result of what I'm doing, plus the fact I'm being paid a reward for how I did it.
Yeah, definitely. And I think that's a really good example of the kind of definition of comparative analysis, and really in the realms of the wealth creation and financial planning and things, its significance as a tool for really evaluating the different wealth building strategies and things that you need to implement to obviously ultimately build your wealth. And it is all about making those informed decisions and not having the fear of, oh, if there's risk involved. If you do the proper planning, there shouldn't be any risk involved. So
there is relatively little risk involved if you understand your numbers and hedge every single thing. In other words, protect every single downside. This is the whole point. This is what I've learned off the masters in anything, even in industry, is if you protect the downside, and the learnings I've learned from all the people I've learned from before, like my managing directors, my finance directors and that, and all the companies I worked from before in manufacturing, if you protect the downside, what's the problem here? If your downside is protected all the time, there's only you're covered for risk every single time. It's interesting, but Scott actually says on TikTok, "How did you buy your first property?" Well, I bought it on a whim. It was like I kind of thought to myself, "There's a property. That's the price it. I know what it's going to cost me to finance it because I worked out as well." And I thought, if I rent it for that amount every single month, that makes sense. And I'll be doing the repairs, so I'll be able to keep that under control. And somebody might come in to do the repairs now and again, and I'll keep that under control. So I can't see this going any side wrong. So what am I going to do to protect my downside of this? I'm going to, before I buy this property, I'm going to actually put an advert in the paper. That's how long ago that was, Scott. I'm going to put an advert in the paper, and I'm going to put 1 bedroom, upper flat, furnished, unfurnished, Aberhill, near to all the amenities, all in quiet, DSS considered. That's what I put. Call that number. And my phone rang off the hook. And I thought to myself, I've got a market definitely for that property at that level and at that area and at that price point as well. I have now covered my rent. I have now covered what I'll get for the bank. I have now covered what the price of the property should be. I have now covered my occupancy rate because I know everybody's going to want it. And these are all and I now covered the things like I know what it's going to cost to refurb or do anything because I've worked all that as well. This is a no-brainer, but most people will look at that scenario and go, oh, there's got to be something wrong.
Yeah,
like it's the flight or fight response. It's the protective mode, which we talk about in comparative analysis. It's the protective mode. There's got to be something wrong with this. This is too good to be true. And it's like, hey, sometimes it's too good to be true. You've just got to realize it is true and just run with it because you've got every base covered and you've got every angle covered. You've investigated as much as possible. And you've got a cast iron guarantee. And if you don't like it later on, hey, I'll just sell the property again and I'll get the same money back. And I'll be no worse off than I was before. But what happens if it did work? Wow. What happens if it does work? Then that's it. Yes, Scott, I do still have that one. I do still have that property. Still, there's no way I'm chopping down the tree that bears the fruit. And actually, I sold it to my limited company because I had a capital gains allowance to offset that year. So I took it in my own name originally, and I sold it to my limited company and paid no capital gains tax on it. And I actually got a loan to my limited company with the money I got in there, so I was able to take that out tax free as a result of that. Job done. It's probably still in there as a loan, to be honest, because I never take money out and I never chop down the tree that bears the fruit. That's the worst thing to do ever. So there's a classic example about how you first get started in property. But in order to buy that property, what I did was I had an endowment policy. I had a versatile investment policy, which is a versatile investment plan. It had a with profits policy. That's what most people, and you'll hear a lot of wealthy people talk about with profits policies and how they borrow against them. But that's what I did in the very beginning, all these years ago, over 30 years ago. I borrowed against my with profits policies because they were guaranteed investment returns. I had a guaranteed amount going to get paid out if I cashed it in the next day. Not superficial, and it will never go down. This was a guaranteed amount. So I took it to the bank and says, I'll get 20 grand for these policies. Can you give me 100% lending on commercial loans? And they went, yep, we can. And that allowed me to buy my first 5 or 6 properties. And then the price of the property started to go up. And that allowed me to buy the next properties, as I've said there. So I used that money. Now watch out for deferred capital gains. But then I did the same thing. But this was all about comparing every single time and assessing all the risk all the way through. So when we talk about conveying investment vehicles, the first thing I actually said to Standard Life, I phoned them up and said, see my versatile investment plans that you've got. Now, they were no longer held as security. So I phoned them up and says, versatile investment plans, what are they returning every single year? And Standard Life went, you know, they're returning 4% every single year, sir. Isn't that a great return? And I went,
No.
is there any point in time you can make 25% return on capital? And they went, what? I went, 25%. Can you make that return on capital with that money? And they went, no, cash them now. Oh, but we need to give you advice. No, cash them now, because I'm getting 25% on everything I'm doing and more at this point in time. Some of them infinite returns the way I'm doing it. So that's why I cashed them. So see how I use that comparative?
Yeah.
It's like I could run them as they are, and I could use them still as security for something else, and I could still build that. But why would I want to keep getting 4% return every single year if I can definitely guarantee myself every single time, guarantee myself 25% return on capital every single time? This is what we talk about, analysing your return on investment, the
Yeah.
ROI. I love this measure. This is a great vehicle for a measure. This is what a lot of people do in industry. They take
Yeah.
the capital amount of their wealth of their company, and then they compare it against the return they're getting every single year. In other words, their net profit. They
Mhm.
divide the net profit by the capital that they've got in the balance sheet, and it gives them an idea about where they are. So, for example, if you're only making £100,000 a year and your balance sheet is sitting at maybe 4 million, it's like you take 100,000 and you divide it by 4 million and then multiply it by 100 to get your percentage, 2.5% return. Now, if the bank at that point in time was offering you 6%, you may as well just cash your money in from the sell the company and put the 4 million in the bank and get your 6% return, which is almost 2.5 times more than what you're getting right now.
So you're still a lot of hassle and time.
Yeah, and you've got no employees. No employees, no hassle, no nothing, no headaches, no bother about production, all the rest of it. Nothing about that at all. You can just take your money and stick it in the bank, and you're gone. You're done. 6%, just like that. This is return on investment. This is why return on investment is important in analysing and different wealth creation strategies.
Yeah.
Now, look how to calculate. We've calculated the return on investment opportunities, the property investment, savings plans, entrepreneurial ventures, and everything like that as well. I think the risk profiles is important. So, what
Mhm.
do we know about risk profiles, Richard?
Well, we speak a lot about risk and risk analysis, and the comparative analysis can help you assess and compare the risk profiles of different wealth creation strategies. Now, we always refer back to property investment, obviously, because it's what we do. But obviously, there's different techniques and things that you could explore. But evaluating risk tolerance or volatility or the downside protection that you spoke about, Jim, and diversification benefits and things across different investment options is really important for having that
Absolutely.
risk comparison. Yeah.
Aye. Somebody actually swears that could have been in Breaking Bad. No, I wouldn't ever break the law, put it that way. That's never a point. I would never ever break the law on anything, even when it comes to tax, because remember, I'm an accountant by trade.
Mhm.
Ignorance of the law is no excuse as far as the courts are concerned. It's the first thing I was told when I was
Yep.
trained to be an accountant. Ignorance of the law is no excuse. That's how HMRC look at everything. There's no way I could ever turn around and say, I didn't know, considering I'm an accountant. And understanding that. So my background in that was perfect for this. It was just teeing me up for this. See, when I talk about preparation, where it will lead you, prepare, learn and learn and learn, be a continuous student. And at some point in time, you will prosper as a result of what you've done before. Everything I've done before has brought me to where I am right now. All my failures and all my successes are where I am right now. And it's pretty good. I'll tell you that. And the future's pretty good as well as a result of that. But this is why anybody can do this. Anybody could do this.
Yeah.
Kind of just hanging around for a long time and making sure that I just kept investment on track. That's all it is. Just being prepared to be bored.
Yeah.
It's
The
literally
risk
just sitting with your
tolerance.
sweeties. It's like you've got the kids sitting in the room. I'll give you a bag of sweeties right now, and they put the sweeties in front of them, going, "Meow, meow, 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 meow," and they eat them all, and they go, "But I could have given you two if you had waited an hour." And it's like, no, I just want to eat them now. That's how most people operate. What I learned to do was, no, I'll just wait for the
delayed
2 in an hour.
gratification.
And then what I did was I got to the hour and went, actually, I'll just wait another hour for 4. And then I got to the other hour and then I waited for the 4. And when I got the 4, I went, actually, I'll just wait another hour for the 8.
Yeah.
I'll just wait another hour for the 16, for the 32, for the 64, for the 128, for the 264, for the 526.
And that's really that delayed gratification for,
Of course it was.
the delayed gratification for that to compound and then really see the benefits of something compounding up over time.
Delayed gratification every single time. That's something you've got to learn. If you don't discipline yourself, someone else will discipline you in the future. Whether it's a boss, whether it's your bank, whether it's your state pension, whether it's your, whether it's your financial circumstances, something else will discipline you later on in life. So you need to be disciplined right now. For all the younger people out there, you've got a golden opportunity now. If I plugged myself into their brain, it's like they would be multi-millionaires. It's so quick because they would understand all the dynamics. It's how quick you can learn all this. It will take you to where you are, but more importantly, how quick you can implement it. That's the key here. So evaluating cost-benefit analysis for wealth creation. The cost-benefit analysis I used to do every single time. Again, going back to industry. Industry for me was great, a great grounding, because what the cost-benefit analysis used to be was, will I take look at cost-benefit analysis with the Huracan. Will I spend 178,000 buying a Lamborghini Huracan, okay, which will go down every single year in value? Now it might retain its value, fair enough, but you've got running costs, you've got insurance costs, you've got finance costs possibly, the cost of finance, but you've also got the opportunity cost that you could use it somewhere else. Because 178,000 bought me a house instead. Now that house will go up in value, but that house was then used to borrow to buy the 30 other properties. See how that worked?
Yeah.
So when we talked about the Lamborghini Huracan opportunity cost in that scenario, in that video, and in this lesson, the wealth creation shows before, we didn't realize that I was going to use that to then buy another 30 properties. That same money, the same money I put into that property was used to buy more property. That money didn't come from me. It came from the increase in property from somewhere else. So that money was generating money on the money, 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 on the money. And it's just all the time. Every single time.
Whereas if you compare that to putting the money into buying obviously Lamborghini, then that's just going to depreciate as soon as you buy it.
Hey, I look good for a wee while. Well, I'm sorry, but I don't do status.
Yeah.
It's like I'm not. Well, I wouldn't apologize for that, to be honest. If you're doing status right now and your Gucci belt or your, Prada handbag is more important to you, you've got your priorities wrong. More important thing for you is making sure you're financially secure, making sure your family's financially secure, and making sure your financial security is not reliant on your ability to perform. Because if it is and anything happens to you, you've lost all your income.
Yeah.
So the cost-benefit analysis is important to assess whether you should put your money there or whether you should put your money here. But in industry, I did it as well. The fact that when they says we've only got 250,000 in capex this year, what do you think we should invest it in? And I'd immediately go, well, if you invest it in that bit of machinery, it'll be that efficient and it'll generate that amount of efficiencies, which will increase your profit by this amount of money or your contribution towards profits. If you put it in that bit of kit, it would increase your efficiencies that way, which would generate that amount of extra contribution towards overheads as well. So therefore, that could generate, 50,000 a year extra in efficiencies. That could generate 40,000. So where do you think you should put your money? Well, we'll put it here. That's cost-benefit analysis. Understanding where you'll put your money in order to get the best. Take into account things like, for example, location, especially in property, market conditions. Market conditions for property right now are fantastic. It's like I have literally got full occupancy in terms of what I'm doing. And it's like there's people still inquiring right now for property. So it's like, wow. What point did we realize that? I knew it would come round anyway, because it's always cyclical, the way it comes round. Every dog has their day. Remember that. Even when you're on a downer right now, every dog has their day. Stick that in your mind and keep it with you and keep telling yourself that. Because as you hang around long enough and keep chipping away, you come back to the top again. And then you'll go back down to the bottom again. And then you'll go back to the top again. But you make sure you minimize the downside and you maximize the upside in that comparative situation. Financing terms, property types, individual goals and investors. Take a couple of mortgages recently, and I've just got them down to half of what they were before. Fixed them on 5-year fixed rate deals, so I've got no hassle about this at all. I know what I've got coming in. I know what's going up in rent anyway. So therefore, that margin's going to get bigger and bigger as a result.
Yeah.
That will allow me to invest more in the stock as a natural result of that as well, and therefore it'll increase the property prices. And then I'll maybe be able to later on. I might, hey, could I get more property? Could I buy more property? Could I buy more portfolios as a result with the same appreciation?
Ultimately, that's the goal anyway, because I mean, the plan is to obviously reinvest. You've got this new stock and reinvest, and then over time, that will then become a lot more valuable, and you could use that to then potentially build even further. So,
Yeah.
An interesting question here before we move on, just about delayed gratification. Gary's asking the questions: how do you balance delayed gratification with spending money on things that might bring you happiness?
This is what brings me happiness.
Yeah, I knew you were going to say
I'm doing the same thing. I love it's just literally just a game of Monopoly, but on a grander scale. That's it.
I think maybe
I have resigned myself to the fact that I'm happy with everybody else in my family and being happy about themselves. I'm happy that my children are happy.
Yeah.
They are happy in what they're doing. I'm happy that Elaine's happy in what they're doing. I'm happy because they're happy as a natural result of that. That makes me happy. And that's all I need. I just need, but I like to be content every single day. And if I'm content, fair enough. And there's days that I'm not so happy, but it's my fault because I've not resolved an issue yet. That's the only reason I'm not happy for most things, is because I've not resolved the issue I should resolve. And once I've resolved it, yeah, I'm back to kind of contentness. So it's not, Gary, it ain't about happiness. Life is not about happiness. Let me tell you what life is really about. And you're not going to like it. It's about procreation. It's about family. It's about having children. That's what we are ultimately here for.
Yeah.
We're not here to enjoy ourselves, really. We're here to procreate. If you really delve right down at the bare basics of humanity and who we are and what we are, ultimately the driving force for us all is procreation. That's why all these wee hormones start to fire off around your body when you meet the right person. That's what that's all about. That's why you get that tickly belly. That's what that's all about.
I don't know, maybe, Gary, you could maybe correct me if I'm wrong. I don't know if maybe what he's referring to as, obviously, in Gary's journey or somebody's journey to create their own wealth creation and on their journey, those things in between, like maybe family holidays and things like that, how do you find the balance with?
I don't find a balance. I
know.
I have extreme delayed gratification because my dream is so big about what I expect and what the next generation, what I want for them. My dream is so big, nothing gets in the way. I'm quite happy to take that. And you see that in most families that run their own shops and stuff like that. They run their own shops, they run their own businesses and stuff like that. They tend to want, their happiness is seeing their children become maybe solicitors, doctors, lawyers, and all the rest of it. That's what they want. But eventually, what that generation will want is they'll want their children probably to end up being self-employed again. Because it goes round in cycles. Everybody thinks that that's what they want, but it just goes round in cycles in terms of what it is. But I will get to a point where I think I really, I wouldn't mind that. The hurricane was a really, I really went through the whole emotional aspect of having the hurricane. But then I thought to myself, I could actually, the comparative analysis and the cost benefit analysis, I thought about it and I thought, nah, I'm not prepared to take a hit for 2 million to buy a hurricane over 20 years, because that's what it'll cost in lost opportunity. I wouldn't take that hit of 2 million. That's how I looked at it. And I thought, there's no way, just for a hurricane, I'll rent it for a week and I'll get it out of my system if that's the case. It might cost me $5,000 to do it, but it's $5,000 well spent because I've now got it out of my system. Most things like that are honeymoon periods. And it's usually because you want to buy things to impress people that you really don't like, to be honest. It's
Yeah.
just Instagram stuff. So that's how I do it. So yeah, and Gary says that I allowed my investments to pay for my summer holidays. Absolutely. That's how I looked at it. I looked at
Mhm.
myself and thought, okay, if I can get to X amount of properties, then Elaine will be able to no longer work. If I can then get to X amount of properties, I will no longer be able be needing to work if I don't
Need to
want
work,
to.
but
But I
you
choose
do.
to work. Remember,
Yeah.
I love doing what I do every single day, no matter what it is. It may sometimes seem like it's not, but I do in general because it leads me to where I want to be.
Yeah.
And you've just got to put up with that in order to get to the result that you're after. So yes, it can be that, but then I think about the trade-off there is, do I really need the top end holiday, or can I just get away with, because it's a life experience. It's a
Yeah.
classic example. Let's look at the Willy Wonka situation. They're slagging that off something
Yeah.
rotten in
I
Glasgow with
know.
the Willy Wonka, but that's the parents. If you ask the children, they probably would have had a fantastic time with that, because they don't see what the parents see. They
Mhm.
just see, their imagination runs riot in that situation. They would have loved that. But the parents decide to have a go and then influence their children. And that's
Yeah.
what caused the problem. The parents, not the Willy Wonka experience itself. It was the parents. It negged, in other words, gave their kids negative and told them how it really was. In other words, telling them Santa didn't exist. Now, let's be honest, Santa does exist for anybody that wants to know that. Or otherwise, how would anything get to your door at the end of the day? So if Santa didn't exist, we wouldn't have it and we wouldn't be talking about it at Christmas. So clearly Santa does exist somewhere in the ether. But that's the typical example. The tooth fairy doesn't exist. Things like that. It's
Yeah.
that's what they did. So that's me. That's me coming back to saying it's not allowing people round about you to negative you, especially if you get in the wrong peer group, because then they go, but you should. The amount of times that people said, you're never going to enjoy it. You're never going to. Hey, I'm enjoying the journey. I'm
Well,
loving the journey. I love the journey. It doesn't matter. I couldn't care less about what I'm accumulating as a result.
mhm.
I just love the journey and love the grind. And if you love the journey and love the grind, it's a foregone conclusion you'll be successful as a result of what you do every single time.
Yeah. We're going to talk a wee bit about peer comparison and benchmarking and things as well. But before, obviously, we move on to that, let's talk a wee bit about comparing savings and retirement plans and things as well, and how important that is. I mean, considerations for comparing different savings and retirement plans, such as obviously with workplace pensions just now, individual personal pensions. I mean, you really need to explore the factors like your contribution limits and your tax advantages from using a personal pension. I know you, Jim, you use that quite a lot to your advantage. Your investment options and your employer matching your workplace pension as well, and what the limits of that are. Do you know what I mean? You look at all this and compare it all to see where you could get the best benefits from your retirements and saving plans.
It's the trade-off, isn't it? It's the
Yeah.
trade-off. It's like what you said about the individual pensions. Do I put my extra £100 I'm getting into my pension and lock it up for the next 30 years, or do I spend it now, or do I
Mhm.
put it now? When I first started out in buy to let, there's no way I'm putting any money into a pension, because a pension will not make the return I'm making. However, when I got later on in life, I thought, I need tax relief on what I'm making. So therefore, I need to bring myself down to lower rate. So therefore, it sprung up and it went, oh, my pension. It's like
Mhm.
now my pension's an advantage. But my pension's also an advantage because when you put the tax relief in, especially if you're close to retirement age, then effectively you're getting the 40% tax back on top of what you're putting in. You're not, well, you're getting it against your tax, but you're also getting the extra basic rate over and above put into your pension. Then when you draw down tax-free 25% of that, because you're near to retirement, then 25% that's tax-free. So you're actually getting a bonus there as well. So when you
Mhm.
work all that out, so there's ways and means to do that. Somebody actually said to me, so you're an accountant, so you know every way how to avoid it. No, no, definitely not. I am still learning how to plan for tax,
Tax
how to
planet.
be tax efficient. Tax efficient. Tax avoidance there's a morality issue. Tax evasion is criminal.
Yeah.
But tax planning is the way forward in terms of what you should be doing. So it's learning how to tax plan. Your biggest challenge when you get to this sort of wealth, it's like, how do I mitigate my tax?
Mm-hmm.
That's it in a nutshell. Theopathetus was actually talked about, was discussing it on Laura Kunzberg, and Laura went, "Would you be
Theo,
prepared to
one of the
pay more?
dragons.
Would you?" Theopathetus from Dragon's Den, you know, the mogul, the multimillionaire mogul, and I think he's in shops and retail. But Laura Kunzberg says to him, "So everybody's saying that the wealthy could pay more tax. Would you be prepared to do that, Theo?" And he went, "Well, no, really." It's like, am I not paying enough as it is? Because you look at the amount of tax that the wealthy people are paying, they're still paying a lot of tax. I'm not talking about the ones that obviously use havens, tax havens and stuff like that, but I'm talking about the normal people that pay corporation tax on all the businesses they run, especially Theopatheus, because he runs a lot of UK businesses. So he's bound to pay a huge amount in corporation tax. So why would it be a necessity? And plus the fact, trying to get more tax out of the rich is disproportionate to trying to get just a small amount of tax out of the masses overall. You can generate far more money just taking a small amount off the masses as you can taking a huge amount off the rich, because the rich then just go, tell you what, I'll move to a different domicile and I'll not give you any tax at all then. That's the key. That's what you have to worry about. That's what you have to do about evaluation, wealth, and creation strategies. Exploring individuals. This is all about peer comparison and benchmarking.
Yeah.
And individuals can benchmark their financial progress, their savings, their investment performance, their net worth against their peers, industry standards, and personal goals. So other people, I don't necessarily, just to be honest, I don't benchmark myself against anybody. I just say, okay, what is the best investment I could do with this right now? It is not volatile and is not putting things at risk to a degree. And then I invest in that. That's it, really. I
When we talk
don't run
about,
away. I mean, people on crypto, it's like, flipping heck, are you off your head?
when we talk about maybe like benchmarking yourself against others, against peers and things, do you think maybe back in early years of your journey, your wealth creation and things, you did look at others and kind of benchmark yourself,
Okay.
like that's where I want to be, or I'd
You're
like
absolutely
to be.
right. So in industry, when we were working in manufacturing, we used to benchmark ourselves against other similar industries like this. So we used to benchmark, used to say, okay, we used to look at our competitors' accounts and we used to go, well, how are they doing in comparison to how we're doing? And are they doing better than us? And if they're doing better than us, then what are we needing to improve on then if that's the case? Because all accounts are publicly available to a limited degree. But if you get a huge company, then they've got to expose everything about their accounts. Plus the fact you could phone your competitors and used to phone them up and just say, you know, we're doing a survey, we're talking about this, how are you doing, all the rest of it. And it's like, you'd be amazed at what they used to tell you. and I used to get it with my own lot, and they're reeling off things on the phone. I went, whoa, wait a minute, who are you speaking to? It's like, oh, it's somebody from a statistical place. It's like, and I'd just take the phone off them and go, listen, if you want that information, write out to us and we'll give you that information. We're certainly not giving you over the phone because we'll have no idea who you are.
Yeah.
Click.
I
learned that from my cleaner days, believe it or not, when I was a window cleaner and an industrial cleaner with my father when I was a teenager. I learned that when Dixon's tried to take over Woolworths. And I learned that industrial, you know, espionage. It is a criminal offence, believe it or not.
Yeah.
But they were caught. Dixon's was caught because there was a Dixon's person walked straight into the office and went up the stairs into the main office itself in Woolworths and Cooper and actually started to ask all the questions from the people in finance. Dixon's had nothing to do with Woolies. There was a person just off the street walked in and started to ask. And the person in the finance thought this person was official and started to really ring off to them, asking who they were. And they were caught red-handed, walking in. They're people walking into the rival that they were going to try and take over. Now that never happened. Woolworths was never taken over by Dixon's as a natural result of that, because that never jailed. But I learned that early on. You know, if you ask people outright with a straight face, they'll tell you.
Hmm.
You'd be amazed. And that's how I started to understand how the banking system worked, how to understand how the mortgage process worked, how to understand the approval process and everything like that. So I got really good at understanding everyone's processes in order to tick all their boxes. So when I applied for anything and I did anything, they could never say no because I ticked every single box they needed. And I still do that today.
Yeah.
I understand what I need to do before I start the journey. I'm not perfect at it, and I don't get to be perfect because you'll never start the journey. But I understand the next step I need to do. And if I don't understand that step, I'll soon find out what it should be. And I'll just do it later on again with someone else.
Yeah. No, it's always good to have that end, not just the end goal, but how you're actually going to get there and how it's all going to play out. So that is really important. Let's talk quickly about evaluating entrepreneurial opportunities and things. And evaluating entrepreneurial opportunities and business ventures and things within wealth creation, it's really where you would look and explore factors like, if we're talking about property, like market demand for property, certain types of properties within, if it's buy to let, obviously in the rental sector, or looking at competitive landscapes and revenue potentials and scalability. And we spoke about obviously the risk reward ratio as well in certain investments. What's the risk involved in comparison to the reward?
Okay, so recently I've ventured further afield just to look at a couple of things. HMOs, you know
Yep.
yourself, that company down south. I spoke to them and talked
Yeah.
about HMOs. They sent me over some information about HMOs and how the HMOs can make. I then weighed that up and thought to myself, but that's not in my control. If anything happens, I can't really control that because I then have to pop all the way down to sort that out. And if it doesn't work how it should done, then it might end up going pear-shaped. And then I looked into other avenues about how that money was generated and what they were telling me. And I was thinking to myself, that can't be possible because they're telling me it's going to generate that. And yet they've got it on the website advertised at that. So if they've got it advertised at that, how are they telling me it's generating that? That doesn't make sense at all. So
Mhm.
I don't think the information they've told me is absolutely right. So that's the risk reward. And
Yeah.
it's like, do you really want to do this? And you nail your facts down, you've gone through your due diligence and you've audited it to make sure that all the information you've been told is factual. And then you can make a decision based on that. And a lot of the times the decision for me is, no, I'm not going to go any further forward.
Mhm. But
However,
you've went through that process to come to
yeah,
that
and
decision.
Aberdeen's a classic one as well. Everybody's like, "Oh, Aberdeen, Aberdeen, Aberdeen," and I'm like, "Flipping heck, what is this about Aberdeen?" It's like Aberdeen, as far as I'm concerned, might have their day because it always will do. But why is everybody on about Aberdeen and plowing their all their money? Dundee's another one. Great Dundee, good luck Dundee, but I'm still waiting the comparative returns here as well in Fife.
Yeah.
So why would I want to change that? To run over 25 miles over the water to go to Dundee. So 25 miles away. When I've got something on my doorstep,
Right on your
it gives a
doorstep, yeah.
better return and it's controllable by me. And we're running it. Why would I want to do that? Why I don't understand that. Why I need to look everywhere else. This is the thing about,
Trying to reinvent the wheel.
well, what it is, it's like everybody wants to get on the ladder straight away. Everybody wants to get on investment strategies straight away. They've all been on a course. They're all wired and fired and they're all jittery. And it's like, I need to buy something. I need to buy something. I need to buy something. I've got money. I've got money. It burns a hole in my pocket. I need to get rid of it somehow. And it's like, I'll take your money if you want, and I'll sell you a property if you want. But I tell you what, the investment return might not match up. And I think that's what happens a lot of times. They all compete with each other. They don't do their own thing.
Yeah.
And if you're doing anything in an entrepreneurial opportunities, stop telling everybody else because that's what I did in the early days. And I shot my mouth off something rotten about where I was buying, what I was buying, what I was making, what I was returning, and every man and their dog started investing.
Started
This
doing
one I
it.
bought the 30 properties off did the same thing on the back of the strength of my conversation. Unfortunately, they failed to do the other things that I told myself to do, and therefore they came a cropper and everything went pear-shaped for them.
Yeah.
And I was able to buy their portfolio. So they did all the effort and put all the effort in. I did nothing except buy them off them. Ready-made at a discounted price. That's good, eh?
Yeah.
Why do I need to do it then? Just get somebody else to do it and then buy it off them later on. A lot of companies do that when they do entrepreneurial opportunities. They
Yeah.
actually just assess the current situation, and acquisition is the trail for them a lot of times in order to grow. in order to, because they've got stacks of cash they get from the money markets,
Just
they
going to
get from
say,
investors that won't invest in them. They have to spend that cash and invest it somewhere. So that's why they go on an acquisition trail as a result of that.
so the acquisitions can be a good way to obviously build and move forward. Obviously, you need to have cash behind you, but you
Yeah.
really need to make sure that you're doing all these comparative analysis on the purchase and obviously the performance of the portfolio if you're buying it or whatever. So
Yeah.
yeah, that's really important.
So definitely, and this is where it comes down to. So it's risk reward, competitive landscape, revenue potential, scalability is definitely the one. How could you scale this?
Mhm.
I talk about this all the time. The only way you're going to scale something is get other people on board with you. I don't mean investors. I don't. Well, if you need the money, fair enough. You might want to do that, but the only way you'll scale it is to get other people to work with you and work with them as well, and reward people appropriately as a result of that.
Mhm.
That's the only way you will be able to scale, or you'll just be an island by yourself, and
Yeah,
everything will be run by you, and you will never set yourself free as a result. You have got another job, by the way. That's effectively what that is. If you don't get other people on board, you've just inherited another job.
yeah. And if you're trying to scale up, you really need the right team. And if it's like property investment contractors and all these types of people who could do things that will save
Why
you
do you
time,
think?
a lot
Why
of
do you
stress.
think? Why do you think other letting agencies like buying other letting agencies? Because all the effort's been put in.
That's all been done. Yeah.
All the landlords have been built already. And then what happens next is they get the other people, they actually get the people that they're buying from to actually pay for it in their profit as they go.
Mhm.
And it's like they've not put anything in at all. That's a madness model. It's
Yeah.
like, I'm going to give you my company for then you to pay me back the profits as we make every single year in order to buy it off me. What? You having a laugh?
Yeah. I know one that's happened with fairly recently.
Who works like that? But that's what one man band operations do,
Yeah.
because it's all reliant on them and they have to do that as a natural result of what they're doing. They don't have any other choice. They're only selling the book. They're not selling the business. You're not selling a
Yeah.
job, you're selling the book. That's what you're selling, and that's how they're doing it, because you're doing nothing from then on, unless you're getting a salary as a result of what you're doing. This then brings us nicely to quantitative and qualitative
Okay.
analysis.
Yeah.
Do you want to explain what that's all about, Richard?
Yeah, so both quantitative and qualitative analysis is really important in the realms of the comparative analysis for your wealth creation and things. And it pays to look at how quantitative metrics, like we say, obviously your ROI, your return on investment, and risk adjusted returns can be complemented by qualitative factors, such as obviously looking at market trends and industry expertise and your personal values and things as well, and combining them together. And this involves really crunching a lot of maybe numbers and using financial metrics, like I said, about the return on investment to assess the potential profitability of your potential investments.
Yeah, definitely. So quantitative and qualitative
Quality.
analysis definitely important in doing that. This is what you're going to get out of it, where the metrics are, as you said, um, market trends, personal the personal values, and what you actually want to achieve out of it.
Mm-hmm.
I think it
In terms of
involves
your, in terms of like
number
your
crunch.
lifestyle and things as well, that's where the qualitative.
Yeah, it's number crunching and financial metrics to assess potential of profitability and investments.
Yeah.
So here's some key quantitative factors.
Mm-hmm.
Quantitative. So you're working out the what quantity it is. In other words, money, profit.
Money. The
So
amount.
return on investment is a really good one, as we talked about before. This is calculating the expected return over the investment period that you're going to get. The next one is cash flow, calculating the net income generated after deducting all the expenses. So cash flow is probably one of the most important ones. Now, the one thing I do all the time is I get Tony to do is like a cash flow analysis.
Analysis, yeah.
There's no doubt about that, because I've known loads of businesses that have run out of cash, but they've been very profitable. And therefore, because they've run out of cash, they've just gone to the wall because they can't pay creditors anymore. You can make loads and loads of profit, but if you run out of cash, you can't pay anyone and nobody wants to do business with you now, even though you're profitable. And I've seen that loads and loads of times where that's happened. And it's primarily it's because they build up lots of debt. So
Mm-hmm.
they become encumbered with debt
Yeah.
to the degree that They're so. I mean, one's recently. One's happened to that recently, and I'm not going to name the name of the company, but I tell you what, the founders are not happy as a result of that, because they've just been left high and dry. And it's like, by the way, we'll just start another company in the morning, a Phoenix company. And it's like, but that's why that ran out, because it ran out of cash. It ran out of cash. Maybe it was very successful, but it ran out of cash because of the encumbered debt it had. Also, the cash on cash return, evaluating cash income generated relative to the amount of cash invested. Literally, if I'm putting, I think in the very beginning, we started off to get where we are, and I built everything where we are on £23,000 invested in the beginning. Yeah. I think it's something like
that's quite an achievement.
I think it's something like, let me just work out that return. That's a 30,000% return on investment. 30,434 return on investment percent. That's no bad for 23,000. But that's including all the work and effort and everything like that, and time involved, and the heartache and everything like that. But that shows you. But that's a cash and cash return when you think about it. That's what it's generated, and that's what it is. And these are the sort of metrics you've got to use. When it comes to qualitative, it's the quality of what you're investing in. The risk involved. Qualitative is quantitative is all about the metrics. I say quantitative would come down to the microeconomics. The qualitative would be more macro, bigger picture.
Yeah.
In other words, what is the overall returns? Whereas the day-to-day returns are the micro, what you're getting every day, because then it builds up to the overall bigger return.
Sorry, when you say about like the micro, so the macro, you're saying obviously would be more the bigger picture.
Macro is always bigger picture. Micro is like minutia.
Would you say that relates to then what your investment's going to then give you in terms of quality of life and things like that?
What's the bigger picture? What is your intention? The macro level for me is the generational wealth and passing it on, and how to do that,
and securing your financial future for your generations to come.
Definitely. For anybody that wants to know any more information, by the way, we do have a Fife property chat, because I know there's a couple of people asking me on TikTok about, how can I learn more about this and all the rest of it. Fife property chat's the last Thursday of every month in Fife, isn't it?
Yeah.
And so that will effectively be on the 28th. So that'll be the 28th of March. Fife property chat, 6 o'clock, and it's usually Mark Inch. But you need to register with us to get there. Now, we've got a waiting list right now for the Fife property chat, because there's only so many people who can get in the room at any one point in time. But if you do want to be on that waiting list, message us direct your contact details, and we will put you on the waiting list, because I've got a funny feeling you might get in at last minute, and it might be a good thing. You might have standing room only, but hey ho, if you want to learn from people that are successful in that field already, and in the property business, then you probably want to get around the property chat group. It's a pitch-free event, by the way. It's not here to sell you anything. We're just people in a room having a chat about property, having a chat about how we did it, and how we succeeded, and what we could benefit from each other. You might be surprised. You might end up finding the next person. It could be your business partner, or it could be your next financer, potentially.
Yeah, there's a lot of good opportunities to make new contacts and things as well. I try my hardest to confirm with everybody before and just prior to the actual day that everybody's going to be attending. People are busy and things come in the way, so people do drop out at the last minute. So that's what the waiting list's there for. And then I could bring people in from the waiting list if you're on it. So by all means, if space is filled, I will have space to put on a wait list, and you could get in. So definitely send us your details to register.
Okay, so when we come to this at the end of this, and we'll just I think we're just about to finish off. Decision making and implementation strategies is another key one of comparative analysis. So decision making and implementation of wealth creation strategies involves selecting the most suitable wealth building opportunities, mitigating risks, and optimizing financial outcomes over time. Now, by using comparative analysis, This is what we've talked about here.
Yeah.
In wealth creation, you can make more informed decisions, maximizing returns and achieving long-term financial goals with greater efficiency and confidence overall.
Yeah.
Now, leverage comparative analysis is a proactive tool for managing your finances and building wealth over time, definitely.
Yeah. It's you say about confidence there, Jim, and I think anybody throughout their journey, as you do this comparative analysis and make these decisions and do your risk analysis, and you will build confidence, because once you make the decisions based on the facts, you see the results and continue to do that, you'll have confidence in yourself in that whole decision making process, and that you're making the right decisions, and not have that fear of making the wrong decision, or maybe fear of success, because you've seen it play out and start to progress. So yeah, definitely a confidence building thing there if you get it right.
So, your final thoughts on this then, Richard?
Final thoughts on that is that obviously if you're maybe unsure about anything that we went through today with comparative analysis, then by all means reach out and have a chat with us about what the best approach is, or maybe the best people for you to be speaking with in terms of maybe making the right investment decisions. We do a lot. Jim, you've got your magic spreadsheet that you do for property investment, and it really does let you stress test things like mortgage rates and things at the moment, and how your tolerance level could be if these change, or your occupancy rate, or rent levels.
That's quite an interesting one, because I was reading this morning that mortgage rates are changing every 15 days just now. So it's almost like, as soon as a mortgage rate's put in place, it's getting pulled already, and another one's been put in its place as well. So it's forcing people to make a lot of decisions quicker and actually just commit straight away. So it's quite a challenging market right now in terms of property itself, but there's still really good properties out there.
There's a lot of good investments.
It's difficult for me to say deals. I just didn't want to sound like the Leeds and the McFaddens of this world. It's like as soon as you start talking about deals, man, deals, it's like, oh my God. It's like what's all that about? It's like, this is an analytical process, in other words, to look at what the best investment strategies are in order to get the right results, in order to guarantee your success. And it's only a matter of time before you get there. As I said, when I go back to I could just sit on this and now I'll have £1 million in rents in 20 years if I just put them up 3% every single year until then. All my rents right now. So that's fine. So if I really want to do £1 million in rents, and that's what my objective is every single year, then okay, I'll just wait 20 years. I could do it quicker though. If I start leveraging and I start using and I start buying more with the equity I've got. I've still got a huge amount of equity in my portfolios in order to do that, but I just don't want to do that because I don't want to. I like the level of tolerance I've got right now in terms of the investment return and also the risk reward as well. I love having minimal risk at this point in time. And why would you want to change that? How much more do you need when you get to that? Oh, I've got to have that yacht. No. It's like, I ain't going to make me happy. I'm going to be pretty pissed that I bought a yacht. That's what I would be at. Like, I'll have to have that car. It's like, no, I'm going to be pretty pissed that I bought that car. It's a depreciating asset. That's the sort of thing. That's the way I look at it. So when I get to one level and I think I'm going to reward myself, it's like, do I really need it? Nah, I don't really need it. And I could live with myself with that each time and just keep, it's that mountain that you climb. You just keep getting the top of the mountain, and the next minute it's like, well, wait a minute, that's no the summit. It's somewhere else. It's like then you get to the next top and you go, hold it. That's still not the summit. And the one I'm talking about is Jabek Tukbel, the Bampot. It's like that mountain and the highest peak in the Egyptian world is a nightmare to climb because it is so deceptive. You just get to the top of the brow, you think, right, I'm there, and it's just over that one. And you get to the top of that one, you think, right, no, it's no. And then you get to the top of the next one, you think, oh damn, it's over there. It's way over there. You can see it, the wee blooming thing sitting up the top of the peak. And you think to yourself, how on earth did I not see that in the beginning? So that's the sort of I love the grind and I love the journey. And once you get used to that, nothing will stop you at anything. learning to love the grind is probably the best thing you can ever do.
Yeah, that all comes down to conditioning and things as well. So.
Definitely.
Good. Well, we will leave it there today, unless there's anything you want to add to that, Jim.
No.
No. That was good. No, I think that was really good. There's a lot of good examples there of how comparative analysis is so important in your decision-making process, especially with property investment or any other investments, whatever your vehicle is for your wealth creation journey. So hopefully that's helped a lot of people today. As I say, any questions, you can still pop them into the reruns, and also anybody's interested in the property chat group, please message myself or Jim, and we'll get you registered and on the waiting list if you want to.
Don't message me.
Don't message Jim there, message me.
Message Richard. Don't message me.
You guys, you could email me direct. It's richard.cook@fifeproperties.co.uk. That's probably the best thing. Right, okay, we'll leave it there today then. That was brilliant, Jim. Thanks very much.
Okay.
I'm going to end that, and
Bye-bye
see
for
you
now.
later.